Pawan and Kathy, can you hear me?
Good evening, sir.
Yeah. Good evening. We'll wait 2 more minutes, then we'll go to this. Okay. Yeah. So as I said in my last session, we'll be discussing these leases. Yeah. Yesterday we had some conceptual discussion on this. Generally, yesterday's session will discuss about the controlling right part. Now, normally the main difference between lease and rent is, in case of lease, the controlling right will be transferred from the lessor to the lessee, but there will not be any transfer of controlling right in case of rent. And we also see the conceptual understanding of the controlling right. Normally, controlling right is nothing but if an entity or if a lessee can use the asset as per their own requirements, then that can be considered as a controlling right. And any actions or any conditions which are imposed by the lessor, which is to minimize the damage to an asset, that cannot be considered when we are recognizing the controlling right. And we also discussed certain examples related to a ship, and we also discussed an example of a crane. And in case of lease, the controlling right, if you clearly see, the right to substantially all of the economic benefits from the use of identified asset, and the right to direct the use of identified asset. So it means the lessee will be having the right to use the asset as per their own requirement, and he will also have the right to receive the economic benefit from that particular identified assets. So this is our yesterday's discussion, and I hope you are very clear with the controlling right part. Do you have any questions on the controlling right question? Any query on that? Okay, then. Yeah. Now, in lessee accounting, first we'll try to complete this lessee accounting. Now, in this lessee accounting, in the initial treatment, except for the exceptions noted later, the lessee should recognize normally if it satisfies, if the agreement satisfies the IFRS 16 conditions. Now, lessee need to recognize a lease liability, and there should also be a requisition for recognizing right to use of assets. So, in simple terms, IFRS 16 says clearly states. Now, normally, let me speak something about IAS 17 also. Previously, we used to follow IAS 17, where in the books of lessee, first we need to classify what kind of lease is that, whether it should be, whether it is a operating lease or whether it is a finance lease. But lease itself clearly states that there will be a transfer of control right from the lessor to the lessee. So now, as per IFRS 16 in the books of lessee, there is no requisition for such classification. So if the lease term is more than 12 months and if it is not a low valued asset, then we need to recognize a lease liability and right to use of assets. Now, lease liability at the present value. Normally, the lease liability is something which is computed by considering the lease rentals which are payable by the lessee, and we need to convert those future lease rentals into present values. So while considering the present value of the lease liability, we need to consider the fixed payments. Now, fixed payments are nothing but at the time of entering into the lease agreement, lessee agreed to pay certain amount to the lessor. So that fixed payments can be considered variable payments. Now, variable payments means in case of certain lease agreements, the lessee agreed to pay the lease rentals with an increment. Increment in the sense every year there will be a specific increase to the percentage of lease liability. So those variable payments, very important point. When you are computing the present value of the lease liability, we need to consider the fees payment, sorry, fixed payments, and we should also consider the variable payments and residual value guarantee. This is very important element. What do you think? What is this residual value guarantee means? Any idea about this? Now, residual value guarantee in the sense, who will give this residual value guarantee? I believe you understood my question. Yeah. Now, residual value guarantee. Now, generally, if there is a lease agreement between the lessor and the lessee, and if the lease agreement gives a right to purchase the asset, nothing but if the lessee can purchase the asset after the lease term at a value which is less than the market value, and if the lessor gives any guarantee to that, nothing but here the lease agreement clearly says that lessee will be using the asset. Let us assume that for 5 years, and after 5 years, lessee, the ownership of that particular asset will be transferred to the lessee. Now, in that case, if if the lessee expects any specific residual guarantee from the lessor, then lessee need to pay certain amount, certain extra amount. So that can also be considered while computing the present. Now, it means in addition to the lease rentals, if the lessee wants any specific residual guarantee from the lessor, then definitely lessee need to pay certain amount, an extra amount. So that should also be considered for computing the present value of the lease liability and the purchase options. So here purchase option is nothing but it includes a reasonable certain to be incurred. Now purchase options are nothing but if LSE have the right to purchase that leased asset after completing the lease term and the termination penalties. So all these are to be considered while computing the present value of the lease liability. So you need to clearly know what we need to include while compute the present value. So fixed payments, I don't think you have any query on this. Variable payments, residual value guarantee, as I explained. So if lessee is expecting any residual guarantee from the lessor, then that should also be considered for computing the present value of the lease liability. Then the purchase options, if the lessee want the right to purchase that particular leased asset at a price which is less than the market value, then that particular amount should also be considered, and even the termination penalties. Before I go with the right to use of assets, participants, if you have any query on this, any specific element, let me know. Can I assume that all five elements which are to be included in the lease liability is clear? Yeah. So then right to use of asset. Now, generally, right to use of asset, a total of initial liability value, that is our present value of the lease, then payments at before the commencement, or we can also say it as a down payment or the advances. The right to use of asset includes these advances and the direct cost and even the dismantling cost. So the right to use of asset will be computed by considering the present value of the lease liability, even the payments or the down payments which is made at the time of lease agreement, any direct cost relating to that, and the dismantling cost. All these are to be considered for computing the right to use of asset. So is that clear, participants? So this is about our initial treatment of lease in the books of lessee. Now, when it comes to the subsequent treatment, now the carrying amount of the lease liability is increased by the interest charge, and this interest is also recorded in the statement of profit or loss account. I believe you might be aware there is a concept called finance cost, which will be accounting, and the carrying amount of the lease liability is reduced by the cash repayments. Now, this particular lease liability amount will be reduced by the lease rentals, which is done. And the right to use of asset is measured using the cost model. Very, very important statement. Very important statement. The right to use of asset is measured using the cost model unless another measurement model is chosen. And this means it is measured at its initial cost less accumulated depreciation and impairment losses. So generally, we will be considering the cost. There is no, in simple terms, we will be considering the cost model unless another measurement model is chosen. Now, it means that it is measured at its initial cost less accumulated depreciation, nothing but whatever the depreciation which we charge on the leased asset. And if any impairment is there, then that particular impairment loss will also be adjusted. So this is how we go with the subsequent treatment, right? And there are certain important points. And here, can I assume that everyone is clear about computation of present value of lease liability, non-current asset, and the recognition of non-current liability and the current liability, or you want me to explain with a small illustration? Can I assume that you are clear on computation of, because generally in the books of lessee, the major computation includes computation of present value of the lease liability. Okay, you want me to do one illustration? Okay, let me show this. Yeah. Let us assume that the total lease term is 5 years. Then the useful life of the leased asset, useful life of the leased asset is 8 years. Then lease rentals is 75,000 per annum. Lease rental is 75,000 per annum. Then advance, nothing but at the time of making the lease agreement, they paid an advance of 50,000. Then due date for lease rental. Due date means when the company pays, when the lessee pays the lease rental. It is generally end of the year. Right. So this is some information regarding this. The lease term is 5 years. Useful life of the leased asset is 8 years. Lease rental 75,000 per annum. Advance 50,000. Due date for the lease rental end of the year. Then effective rate of interest is 9%. So this is the information. Now we are computing in the books of lessee. So the first thing in the books of lessee is the step 1. We need to compute. The first step is computation of present value of the lease liability. computation of so computation of present value of the lease liability is our first step. Step number one. Now, present value of the lease liability is nothing but whatever payment you are making, we need to compute its present value. So here, the lessee is paying 75,000 per annum. They are paying 75,000 per annum, and they paid an advance of 50,000. Effective rate of interest is 9%. So what will be the present value of this particular lease liability? Now here directly, because there is no change in the lease rental, we are paying only 75,000. So you can take the annuity factor for 5 years at 9%. Now these annuity factors, I believe everyone knows. So you can take the annuity factor for 5 years, and by considering that particular annuity factor, you can compute the present value of the lease liability. 1 second. Generally, in your examinations, definitely the present value factor will be given. The annuity table will be given, so no need to worry about this. Suppose annuity table. Generally, the annuity value. 1 second. Sorry. Yeah. So the rate of interest is 9%. So for 5 years, the annuity factor will be 3.88. Now, this will be given in the exam, and most generally the annuity factor will be provided. So for 5 years, the annuity factor at the rate of 9% is 3.88. And we'll take the same value here. So 3.88. So annuity table. So the annuity value is 3.88. So the first step, as I mentioned, we need to compute the present value of the lease liability. So how we will be doing this? 75,000 per annum into 3.88. So the present value of the lease liability. Present value of the lease liability will be 2,91,000. So I hope it is clear to all. Any query? Yes, shall I continue? So this is our first step in the books of Lessee. Then the step 2, we should recognize the right to use of asset. The second one is we need to compute the right to use of asset. Now, generally, what we need to include in the right to use of asset, first we'll be recognizing the down payment which we made, nothing but the advance amount, that is 50,000. And we should also recognize the present value of the lease liability which we got from the step 1. And in addition to this, we should also include this, that is direct cost, if any direct cost incurred regarding to the lease. Now, what do you think? What kind of direct cost will be incurring? In case of lease agreement, what direct costs in general will be incurring? I hope you understood my question. Yes, participants. Now, generally, the common kind of direct cost which we can include is whatever the yeah, I think I got an answer. Let me say this. Yeah, cost of transferring the asset. Yeah, cost of transferring in the asset and that like the registration fees and whatever amount which we incurred for those bond papers and all these things, the brokerage expenses, and if it is there, if any notary is done for the lease agreement, all these will be considered as a direct cost. So the right to use of asset will be computed by considering the advance amount, nothing but a down payment, then initial present value of the liability which we got from the step one. And if you incur any direct cost, that is registration expenses for registering the lease agreement, then if the lessee is having an obligation regarding the dismantling, that should also be considered. Suppose if there is any legal requirement for the lessee to incur the dismantling expenses after the lease term, then that should also be included in right to use of asset. So I hope I am clear on this. So as per step two, right to use of asset means we will be including the advance amount 50,000 plus the present value of the lease liability, that is 2,91,000. So the total right to use of asset which we should recognize is 3,41,000. So can I proceed with the step three? I hope these two steps are clear, participants. Yeah. Now the next one is what we need to account it in the statement of we step three. Now generally in step three, what relating to this particular lease, what we need to account it in our statement of profit or loss account. So in our statement of profit or loss account, we'll be recognizing depreciation. So depreciation we need to record in the statement of operation. But here you need to you should be very clear how to consider or how to charge the depreciation. Normally, the formula which we use for charging the depreciation is cost of asset minus residual value divided by life of asset. But in case of lease, now in order to charge the depreciation, first we need to see the lower of the lease term or the useful life of an asset. Now, in the given case, you can find the useful life of the asset is 8 years, but you're taking this asset on lease basis only for 5 years. So always we need to consider the lower of lease term or the useful life of an asset. Of course, there are certain exemptions. Now we'll discuss that exemption, but generally the depreciation should be charged by considering lower of useful life of asset or the lease term. So in this particular given illustration, we need to charge the depreciation by taking 5 years. Now, as I mentioned, there are certain exemptions like if the lease agreements gives a right to purchase the asset after the lease term, nothing but if the lessee can purchase the asset at a value which is less than the market value after the lease term, in that case, the lessee can charge the depreciation. It means if the lessee is having the purchase option and the lessee can charge the depreciation for total 8 years instead of charging for 5 years. Because the concept of lower of lease term or useful life of asset is not applicable if the lease agreement gives a right to the lessee to acquire the property at a price which is less than the market value. That is one exemption which can be considered. I hope it is clear. Is it clear, participants? Or you want me to repeat it? So, yes. Now, in this case, there is no such condition. So we assume that depreciation will be charged lower of lease term or the useful life of an asset. So the depreciation amount will be, and the depreciation should be computed on right to use of asset. So we got right to use of asset as 3,41,000 divided by the lease term 5 years. So we'll be charging 68,200. And there is an unbounding effect when you convert the future lease rentals into present value. So for that, we need to compute finance cost in the statement of profit and loss account. So the finance cost will be computed on present value of your lease liability. The present value of the lease liability is how much? 2,91,000. Or let me put in this way, the finance cost will be computed on 2,91,000 into our effective rate of interest 9%. So you will be charging 26,190 as finance cost in our statement of profit or loss. Then the next one is we need to recognize the non-current liability and the current liability. Now, when you compute this NCL and CL of the lease, first we need to see what is the due date of lease rental, whether the lease rental is paid as an advance, nothing but at the beginning of the year, or whether the lease rental is paid as an arrears, nothing but end of the year. So because the complete different treatment is there for computing NCL for arrears and for advance. So first here they clearly mentioned that the due date for the lease rental is end of the year. Nothing but it is in arrears. So in that case, how to compute this particular non-current liability and the current liability? Suppose year total lease term is 5 years. Total lease term 5 years. And the present value, nothing but the opening value of the lease liability. So opening value of the lease liability here is nothing but our present value in the end is 2,91,000. Then we computed a finance cost for the first year. So the finance cost will be that is 2,91,000 into 9%, that is 26,190. Then we'll be paying lease rental. We paid a lease rental of 75,000 in the first year. So 75,000. Then you should compute the closing liability. So the closing liability will be so nothing but how we will be getting the closing liability. If you can recollect, we already discussed opening liability plus the current year finance cost minus the lease rental which is paid to the lessor. So 2,91,000 plus the finance cost 26,190 minus the lease rental 75,000. So the closing liability for the first year we got it as 2,42,190. Now this is the actual closing liability of the lease. Now in this 2,42,190, we need to separately show what is the non-current element and and what is the current element. So when you are paying the lease rental on arrears, in order to compute this non-current liability, you should compute the closing liability for your subsequent period. Now let me show the closing liability for the subsequent period. So the first year closing liability will be the opening liability for the next year. Then again on this we need to charge the finance cost, that is 2,42,190 into finance cost of 9%. Then the lease rentals, that is 75,000. Then our closing liability for the second year. So so the closing liability for the second 2 lakh less finance cost minus the lease rent. So here for the first year we got a closing liability of 2,42,190, and the second year we got a closing liability of 1,88,987. So the subsequent year closing liability should be considered as non-current liability for the first year. That is 1,88,987 will be the non-current liability for the first year, And the current liability will be the current liability for the first year, that is difference between the closing liability and the non-current liability. That is 2,42,190 minus the non-current liability 1,88,987. So this 53,203 will be recognized as a current liability. Is that clear, participants? Any query on this? Yeah. So same treatment is applicable. So for second year, third year, fourth year, and do remember for the fifth year there will not be any non-current liability. Now generally the fifth year the lease payment will be equal to the whatever the lease rentals which are paying by the lessee, that will be equal to your current liability. Now this will do if it is if we are assuming that the lease rentals are paid in arrears. And similarly, if the lease rentals are paid in advance, suppose this is for arrears, and if the lease rentals are paid in advance, now in that case, now here advance in the sense we are assuming that the lease rentals are paid at the beginning of the year. The lease rentals are paid at the beginning of the year. Now in this case, we do have an opening lease liability of 2,91,000. Opening lease liability, we are having it as 2,91,000. Then at the beginning of the year, the same date, we will be paying a lease rental of 75,000. So in this case, the finance cost, how we can compute the finance cost? 2,91,000. From that, you need to deduct the lease rental which is paid at the beginning, that is 75,000. And on the net value, you need to compute the finance cost. So here the finance cost will be 2,91,000 minus the lease rental 75,000. Sorry. Yeah, 2,91,000. So 2,91,000 minus 75,000 lease rentals into your finance cost, that is 9%. So this will be the procedure for finance cost and the closing liability. So the closing liability is nothing but whatever the value which we got, that is 2,91,000 minus 75,000 plus 19,440. So this will be considered as your closing. And whatever lease rental which you are paying, that
Sorry,
can,
sir.
yes.
Can I just see the finance cost again, the first year? Yeah.
Yeah. So the finance cost, how we will be computing is the total present value of the lease liability, we got it as 2,91,000, right? From that, we need to deduct the lease rental which is paid at the beginning of the year. Now, because we are paying at the suppose if the lease agreement is done on 1st January, then immediately the first lease rental will be paid. So that's why we say it as advance. So 2,91,000 minus 75,000. On that, you will be computing the finance cost.
Okay, sir.
Is it clear? Yeah. Yes. So then the closing liability will be here. Just you can see the closing liability 2,75,000 minus 75,000 plus 19,440. So that should be considered as your closing liability. Any query, participants, on this? Any question? Now this treatment is considered when you are paying the lease rental in advance. And this is normally if nothing is given, we need to assume that the lease rentals are paid in arrears. Because generally the lease amount, the lease rental for the first year will be paid at the end of the year only. So it will be done at the end of the year. So we need to assume that it is paid in arrears. But if they specifically mention that it is paid in advance, then this is the procedure which we need to compute for computing the closing liability. Okay. Now, what will be the current liability here? How much current liability we have seen? For your better understanding, just give me a second, 1 second, so that you won't have much. Interest. Just 1 second. I think you can say this one. Just see this. Oh, this is a procedure for rentals in arrears, and this is for procedure for rentals in advance. Can you see this, participants? Can you see this?
Sir, in the question that you gave, how would we know that it is in advance or due?
Here I mentioned the due date for the lease rental is end of the year.
Oh, sorry. Okay, yes.
Okay. So if nothing is given, we can assume that it is arrears only. Okay. Okay. You want me to show the current liability? No issue. Let me show this. First, let me show this one. Yeah. So here, if it is paid in advance, means the opening balance and the rent paid. So the rent paid will be deducted and we'll get the net balance. Then on this net balance, we'll be computing the finance cost and the balance carried forward to the statement of financial position. And in case of arrears, here you can see balance forward, finance cost, then the rent paid, then we'll be getting this. Now, as you asked, how to get the current liability in case of now in this case, how much amount we need to consider as current liability, because we got closing liability as 2,35,440. In that, what will be the current liability? Very simple, 2,35,000, and if you deduct the lease rentals, if you deduct the lease rentals, then that will be because you are paying a current liability is nothing but whatever lease rental which you are paying. How much we are paying? 75,000. Then the non-current liability will be 2,35,440 minus 70. So 1,60,440 will be showing it as non-current liability, and 75,000 is your current liability. Is that clear, Neil? Yeah, in arrears. Okay. Now, in arrears, in order to compute the current liability, this is nothing but 2,42,190 minus non-current liability will be your current liability. How we will get this 1,88,988 current liability? The closing liability of the subsequent year will be considered as the non-current liability for the current year. Because just try to understand, at the end of the first year, we are showing a closing liability of 2,42,190. In that, which we need to compute what will be the liability for the which is not related to the current year. That is nothing but the non-current liability. So if you compute the closing liability of the next year, then that will be the non-current liability part. So participants, I hope you understood this concept. Any query on this? So this is how we go with the leases in the books of Lessee. Any question? Yeah. Before going it in the books of Lessor, now let me discuss sale and lease back, because this is one of the major chapter, major concept in our lease account. So, and one more thing is exceptions. Now, generally, IFRS 16 says that if the lease term is more than 12 months, we need to compute the present value of the lease liability. And if the lease term is less than 12 months, then you can show the lease rental as an operating expense in the statement of profit or loss account. Similarly, a low value asset. Now, actually, there is no specific threshold limit for this low value asset, but we assume that if that cost of the asset is less than 5,000, we assume it as low value asset. Less than $5,000, we assume it as low value asset. Now, if it is a low value asset, but very important point which you need to understand, the concept of low value is applicable only for new assets, not for the what is this used assets. The concept of low value, because this low value and less than 12 months are the exceptions. In this case, the company company need to show the lease rental as an operating expense. Now, low value as per IFRS 16 means if the asset, if the cost of that particular leased asset is less than $5,000, we assume it as low value. Why? Because here you can apply the concept of cost and benefit. So it makes no sense to apply all these things if the cost of the assets which we acquired is less than $5,000. And another important version for the low value asset is it also states that if the economic benefits which we receive from that particular leased asset is not significant, of course, it is not included here, but there is a proposal to include that particular point also. If the economic benefit from that particular leased asset is not significant, then you can it consider it as an exempted asset. It means instead of recognizing it as an asset, then you can simply recognize the lease rental as an operating expense. If you can understand, it makes sense also, right, participants? Suppose if I purchased an asset and if I am paying a lease rental and the economic benefit which I receive is not significant, then you can also apply nothing, but you can also consider the lease rental as an operating expenses. So these are the exemptions for this. So any query on exceptions? Shall I go with sale and leaseback? Yeah. Now the sale and leaseback. Now generally, first we try to understand the sale and leaseback. Normally, the companies, in order to fulfill their short-term fund requirements, they will be selling the asset, and the same asset will be taken on lease from the purchaser of the asset. Here you can see the treatment of sale and leaseback depends on whether the sale represents the satisfaction of the performance obligation, nothing but performance obligation as per our IFRS 15 revenue from contracts. So here it is clearly mentioned that seller and lessee, suppose if that particular transfer is not considered as a sale, if it is not a sale as per IFRS 15. So X Limited company just transferred an asset to Y Limited company, and for such transfer, X Limited received an amount of 50,000 from the Y Limited, and the same asset is taken from the Y Limited on lease basis. Now, in that case, it is not a sale because the whatever the required conditions as per IFRS 15 is not satisfied. So in this case, we continue to recognize the asset. You cannot de-recognize the asset because there is no transfer of risk and reward or the control on that particular asset. So if there is no transfer of risk and reward and control on the asset to the other party, then definitely you need to recognize it as an asset. Continue to recognize it as an asset. And whatever proceeds which you receive from the purchaser, it should be recognized as a financial liability. So the proceeds which is received, it should be recognized as a financial liability. Now this is applicable only when we are assuming that the transfer is not a sale. And if the transfer is a sale, very important, if the transfer is sale, if there is a transfer of risk and control to the purchaser, then first important thing in the books of seller is you need to de-recognize the asset because you are disposing an asset. So you need to de-recognize the asset. That should be your first step. And the next and very important step is you need to recognize the right to use of asset because here you are taking the same asset on lease basis. Now, first you need to recognize a right to use of asset, very important, as the proportion of the previous carrying amount that relates to the rights retained. You need to recognize a right to use of asset as a proportion of the previous carrying amount that relates to rights retained. Suppose, example, X Limited sold an asset to Y Limited. Let me put it on Excel sheet. So X Limited sold asset to Y Limited. Now we are assuming that the right what is this control is transferred to the Y Limited. Now, and the same asset is taken on lease basis. So they sold an asset to Y Limited. At that time, the carrying value of the assets, carrying value of the asset is, we'll assume it as 1 million. And they sold it to Y Limited with a fair value of 1.5 million. So the carrying value of the asset is 1 million. It means at the time of disposing, at the time of selling the asset to the Y Limited, its carrying value is 1 million and we sold it for 1.5 million. So IFRS 16 says that in case of sale and leaseback, on what basis the right to use of asset should be recognized? Because you sold the asset for 1.5 million because the purchaser, the Y Limited purchased it for 1.5 million. And you're taking that particular asset on lease. Same asset you are taking on the asset on lease. Now, don't you think the lease rentals will be computed on the basis of fair value rather than carrying value? Let me repeat my point. You are assuming that there is a sale transfer. And at what price you sold to the Y Limited? 1.5 million you sold it. And you are taking the same asset on lease from the Y Limited. Now, on what basis the Y Limited will decide the lease rental? Will they decide on the carrying value or nothing but carrying value of the seller or the carrying value of the at what value they purchase? Definitely they will be considering the fair value only, right? On basis of this 1.5 only, the lease rental amount will be decided. I hope it makes sense, participants. Did you understood my point? Yes. Or you want me to repeat it? Okay. Okay. Now example, I sold my asset to Neil. Now when I am selling my asset, the carrying value of that asset is 1 million. The carrying value of that asset is 1 million. And I sold the asset to Neil for 1.5 million. Here I am assuming that the right is transferred to Neil. And the same asset I took it from Neil on lease basis. Now my question is, on what basis Neil will fix the lease rentals for that? On what basis the lease amount will be fixed? It will be fixed on 1.5 only, right? Because he purchased it for 1.5. Now, if you want to give that particular asset to someone on lease basis, definitely he will be considering that 1.5 million only, right? It means the price at which he purchased. I believe you understood my point. Yeah. So whatever IFRS 16 says is, in case of sale and lease back, suppose now generally how we will get right to use of asset, nothing but the present value of the lease liability. Suppose in this case, I assume that the present value of lease liability is just I'm assuming it. I'm assuming that 4 lakhs. Now here this present value of the lease liability, if you don't have any down payment, we assume it as our right to use of asset. So right to use of asset, at what price we need to recognize the right to use of asset? That is the question. So if your present value of the lease liability of this 4 lakhs is computed on the basis of its 5.1.5 million, it means the lessor will fix the lease rental on the basis of the price at which he purchased. So he purchased for 1.5. So definitely the present value will also be computed on this 1.5 basis only. But whatever IFRS 16 says about sale and leaseback is, we need to convert this right to use of asset from on fair value basis to carrying value basis. If your right to use of asset is 4 lakhs for 1.5, that is for fair value, what will be the right to use of asset for carrying value? Nothing but 4 lakhs into 1 divided by 1.5. So you need to recognize our right to use of asset as 2,66,667. So this is a point which is explained here. Exactly. Correct. So here you can see, recognize the right of use of asset as a proportion of previous carrying amount that relates to the rights retained. As I mentioned, that relates to the rights retained. Clear? Now proportion of the rights retained is nothing but your carrying value only. Na? Any question, participants, on this computation? Shall I show a small question on this? Will you try? Will try to understand? Just let me show this. Yeah, it is a rights retained. Correct. Yes, Neil. It is this 2,66,000 is the. That's why we say right to use of asset. Rights retained. Okay. Just give me a second. Can you see my Word document? Can you see my Word document, participants?
Yes, sir.
Yeah. Now here, just see this one. On January 2006, Sideshow sold a property for its fair value of 2 million, transferring the title to the property on the date. Then Sideshow then leased it back under a 5-year lease, paying 1,50,000 per annum on 31st December each year. The present value of the rentals payable was 5,99,000 and the interest rate implicit in the lease was 8%. So the carrying amount of the property on January 2006 was 1.6 and it had a remaining useful life of 20 years. So what entries should be made in the sideshow statement of profit or loss for the year ended 31st December 2006? So at what should be the values? Generally, the step one is we need to compute the right to use of asset. Normally, the present value they gave it. The present value they gave it as 5,99,000. Now this 5,99,000 is on the basis of this fair value of 2 million. Now in order to compute the right retained, how we can do that? 5,99,000 divided by 2 million into its carrying value 1.6. Then you will get the right to use of asset. Then on that you will be charging the depreciation. Then on the present value you will be charging the finance cost. and even the profit on disposal also very confusing. Most of the students are generally confused here. Even the profit on disposal. Normally, how we will get the profit on disposal? We just compare the disposable value and the carrying value. So here in this case, 2 million minus 1.6, that is nothing but 4 lakhs is our profit on disposal. But in case of sale and lease back, you need to compute the profit only on unretained part. Try to understand this. In case of sale and lease back, you need to compute the profits on disposal only on the unretained part. You cannot compute the profit on the retained part here. I hope you are with me. Is that clear, participants? Yes, or you found it confusing? Or you want me to show this computation in Excel sheet? If you are confused, please let me know. Okay, 1 second. We'll discuss in steps. First, step 1, we should compute right to use of asset. So how this right to use of asset will be computed? As per the question, they gave the present value of the lease liability as 5,99,000. And here the statement says that we need to compute only right to use of asset only for the retained part. So how it will be done? 5,99,000 into 1.6 divided by, so I hope this part is clear. The step 1, right to use of asset. Now the step 2, we should compute depreciation and finance cost. On depreciation, I believe you might be aware the depreciation will be so that is the total right to use of asset. We got it as 4,79,200 divided by the lease term is 5 years. So we'll be showing 95,840 as depreciation, and finance cost, which will be computed on the present value of the lease liability, that is 5,99,000 into your implicit rate of interest is 8%. So we'll be showing a finance cost of 47,920. But here the question is, because in this case of sale and lease back, you are assuming that the control is transferred here side. So then here you can see transferring the title to the property on that way. It means you are assuming that the control is transferred to the your purchaser. So whenever you lost the control, now as per conceptual framework, whenever you lost the control on an asset, now definitely you need to de-recognize the asset. Even the standard also says the same thing. If you're assuming that sale and leaseback is actually a sale transfer, then you should de-recognize the asset. And immediately after de-recognizing the asset, definitely you need to recognize profit or loss on disposal. Suppose let us assume that this is not lease. I sold an asset because I'm losing the control on that. It means I lost the control on that when I sold the asset. I de-recognized it. Now, when I de-recognize it, I need to recognize the profit or loss on disposal. How we generally get profit or loss on disposal? At what is its carrying value? At the time of selling, what is its carrying value? 1.6 million. Here you can see. And at what price you sold? 2 million. Now, generally, the difference is considered as the profit or loss on disposal. Here, because the sale proceeds or the fair value is more compared to the carrying value, so we assume 0.4 million as our profit on disposal. This is normally for an asset, a sale of an asset. But in this case, it is a sale and lease back. You sold the asset and the same asset you took it on lease. Now, the conceptual framework clearly says that if you are again retaining the control on that, you cannot recognize the profit or loss on disposal on the retained part. I believe it makes sense also, participants, right? You cannot recognize the profit or loss on disposal on the retained part. It should be recognized only on the unretained part. So how to compute this profit or loss on disposal here? Let me show this profit or loss on disposal. Nothing but profit on disposal. So that is 4 lakhs. 4 lakhs. Now, the total you sold it for 20 lakhs minus. Now here what we are trying to do, we are trying to compute the proportionate of unretained part. 20 lakhs as the price at which you sold it and you retained it, that is 5 lakhs 99,000 divided by 20 lakhs. So the profit on disposal which you will be getting is 2 lakh, nothing but this 2,80,200 is related to the recognition of profit on disposal for unretained part. I hope it is clear, participants. Any query? Yes, you can see the computation in the question and let me know if you have any queries. Yeah. Now we'll see an example question on this. Can you see my screen? So there is a company called Iriaco, is an internationally successful football club. So this company is preparing the financial statements for the year ended 31st October 2005, but it is currently facing liquidity problems. They clearly mentioned that the company is facing liquidity problems. So stadium sale, lease back and improvements. So first we'll focus on this. So this company has entered into a contract regarding its stadium whereby it will sell the stadium on 30th November 2006 and immediately lease it back. So the directors of the company wish to classify the stadium as a non-current asset held for sale in its financial statements for the year ended 31st October 2005, as they believe the sale to be highly probable at that date. So the sale contract requires the disposal of the stadium for its fair value, that is nothing but the market value of 30 million, and for Lariaco to lease it back over 10 years. So the present value of the lease payment at market rates on 30th November 2006 will be 26 million. The market value for a stadium of this type has not changed in several years and is unlikely to change in the near future. So the stadium is depreciated by 5% per annum using the reducing balance method. And in the year 31st October 2006, it is anticipated that 2 million will be spent to improve the crowd barriers in the stadium, and there is no legal requirement to improve the crowd barriers. So the company has incorrectly treated this amount as a reduction of the assets carrying amount at 31st October 2005, and the corresponding debit has been made to profit or loss. So at 31st October 2005, the carrying amount of the stadium after depreciation and the reduction of the crowd barrier improvement is 80 million. So just I request you to please once go through this. Once you're done with the reading, let me know, participants. Done with the reading. Can we assume that it is a sale and lease back? As per, can we assume that the risk and reward is transferred? So as per IFRS 15, can we assume it as a sale transfer? Yes. Yeah. So if we can assume that it is a sale transfer. Now, if it is a sale transfer, participants, what is our first step? If it is a sale transfer, what is our first step? What we need to do? What is our first step? Rights retained and rights sold. Perfect. Very good, Neil. So first thing here is we need to compute. Yeah. Right of use. Perfect. Now, first thing here is we need to compute the carrying value of the asset because they didn't mention the carrying value of the asset. Entered into a contract regarding its stadium whereby it will sell the stadium on 30th November 2006. Now we need to compute the carrying value of the asset on 30th November 2006. So what do you think? What will be the carrying amount? Because why I'm saying this is just try to see in the year end 31st October 2006, it is anticipated that 2 million will be spent on to improve the crowd barriers in the stadium, and there is no legal requirement to improve the crowd barriers. And the company has incorrectly treated this amount as a reduction of the assets carrying amount at 31st October 2005 and the corresponding debit has been made to profit or loss. Now at 31st October 2005, the carrying amount of the stadium after deducting depreciation deduction is 18 million. Now, what do you think? What should be the carrying amount, participants? How much amount we need to recognize? It means, do we need to, because at 31st October 2005, they showed it as 18 million. Is it right to consider it as 18 million? Or do we need to add this improvement of 2 million to that? Add. Very good. Perfect. Now let me do it in Excel sheet. Just I am opening my Excel sheet. 1 second. I hope the font is comfortable for you participants. So the carrying amount of the assets. So here they gave the carrying amount of the asset as 18 million. So the carrying amount, actual carrying amount. So actual carrying amount as on 31st October 2005. It should be you can also show it is nothing but 18 which they gave, and we should also show this improvement of 2 million. So total comes to 20. And I hope I'm clear on this first step, right? Then we need to compute the depreciation. So on what basis they are computing depreciation? They mentioned that the stadium is being depreciated by 5% using the reducing balance method, right? Now the depreciation, we should compute it. So the depreciation will be 20 into 5%. So we got a depreciation of 1 million. So I hope this is clear. Any question? Then this particular depreciation is now here you can see we charge this particular depreciation for the year end up to 31st October 2006. But here you can see sell the stadium on 30th November 2006 and immediately lease it back. So they are going to sell the asset on 30th November 2006. So it means we should also charge this depreciation for 1st November 2005 to 31st October 2006. And the company decided to sell it on 30th November 2006. So again, we need to charge the depreciation. That is for 31st, sorry. It is for November 2006. So what will be the depreciation for November 2006? Because it is a reducing balance method, then it will be 20 minus depreciation 1 into our depreciation is 5% into how many months depreciation we need to compute? 1 divided by 12. Twenty minus 1, that is 90 on that 5%. Is it clear, participants? $1 million is for 13 months. Yeah, sorry. This is 1st October 2005 to 1 second. Sorry, Neil, a small correction. This is the financial year ends on 31st May 2000, 31st October 2005, right? Financial year will be on 31st October 2006. So this will be for 1st October, that is 1st November 2005 to 31st October 2006. I hope it is clear. Instead of October, just I typed it as. So just try to consider that. Clear? Now the depreciation for 1 month should be computed. We need to compute the depreciation for 1 month. So that is the total carrying value as on 31st October 2006 will be 20 minus 1. You will be getting 19 million. And on that particular 19 million, we need to compute the depreciation at the rate of 5%, and it should be only for 1. So the carrying value will be 20 minus 1 minus 0.79. So you will be getting a carrying amount of or carrying value as on 30th November 2006. Participants, please let me know if you have any question up to now. Shall I assume that it is clear? This is our final carrying value, 18.9. Yes, shall I go with the next step? Then our sales value. Yeah. So we sold it for, yes, yes.
Can I just see once again the carrying value?
Okay. Carrying value on 30th November 2006, right?
Yes.
Yeah. Carrying amount 20 million minus depreciation from 1st November 2005 to 31st October 2006. Right? Then the November month depreciation, that is November 2006. 20 minus 1 minus 0.07.
Okay, sir.
Okay. Yeah. Now at what price we sold it? What is the sale proceeds? Yeah. The sale contract requires to dispose the stadium. They are selling for how much? 30 million. So sale proceeds, we can assume it as 30 million. Okay. Now, the present value of the, now we need to compute the right to use of asset. So this right to use of asset, we know that it should be computed on the basis of carrying value. So what will be the right to use of asset here? Now here they clearly mention that the present value of the lease payment at market rate on 30th November 2006 will be 26 million. So our right to use of asset will be, I require students, I request you to please let me know what will be the value, right to use of asset. The present value they gave it as 26 million. So what will be the right to use of asset here? Just see the question, please let me know. So you have the carrying value and you also have its fair value, nothing but sales value. Yes. (26) divided by 30. Here, Kathy, just see this. We are computing right to use of asset. So they gave right to use of asset as 26 million. 17.33. I got it from Neil. That is 17.33. See, your present value of the lease liability is 26. Now this is computed on the basis of 30. So how we got this 26 million on the basis of the sale proceeds. But we need to get right to use of asset on this particular lease, that is carrying value 18.92. So what will be right to use of here 26 into 18.92 divided by 30. So we'll be getting 16.39. Is that clear? Because the 26 million of the present value which is given, it is on the basis of our sale proceeds of 30. But we need to compute this base on this particular basis. So if it is 26 for 30, then what will be the value for 18.9? So the right to use of asset which we get is 16.39. So before I go with the next step, participants, please let me know if you have any query on this. Now, will you try the next step? What will be the profit on disposal? How much amount we should consider? What will be the profit on disposal? Because profit on disposal should be computed only on the unretained part. It should be computed only on the unretained part. So how to go with that? Just try to think. Okay, no problem. No issue. Don't worry. I will be showing you. Don't worry. Yeah. I hope this right to use and carrying value is clear, participants. Now, the profit on disposal. Now, in case of profit on disposal, actually our carrying value will be now generally. So the carrying value and the this one, that is disposal value. So disposal value will be how much? 30 million, and we got a carrying value of 18.9, right? So 30 minus 18.92. Now this profit on, now we need to compute only the profit on disposal for unretained part, because we need to show it in the books only on unretained part. So how we will go with this unretained part? The first one is the profit on disposal, which we got it as 11.08. 11.08. Then 30 is our the disposal value minus the right to use of asset or the present value. One second. Yeah, the right to use of asset, we got it as 16.39. One second, please. Here they didn't. Yeah. It's a small correction. Just please 1 second. 1 second. Just give me 1 second. Present value of the lease payment at market rate on 30th November 2001 is 26. Yes, participants, a small correction, please. So 1.48 will be our profit on disposal. Just try to see 11.08 is a profit on disposal, but you need to consider only the profit on disposal for the unretained part. So how we will be considering 11.08? 30 is nothing but the sales price, minus 26 is nothing but the present value of the lease liability, divided by 30. So the profit on disposal for unretained part will be 1.47, nothing but you can write it as 1.48. So I assume that it is clear. Any question? Just look into the computation. If you have any query, let me. Yeah, present value of the lease payment. Correct. Yes. Yes, Neil. So, shall I assume that the concept is clear for all? Kathy, any query from your end?
No, sir.
Yeah. Then next one. So this should be the accounting treatment for this procedure. The company need to follow this. Okay. Now here the company, this is related to intangible assets. We'll try to see only for questions on sale and leaseback. Now the next one is on in the books of Lessor. So how we need to treat the financial statements in the books of Lessor. Now this is completely new to you. It is not there in your financial reporting. Books of Lessor accounting is not there. Now, lessee must be nothing but leases must be classified at inception as either a finance lease or an operating lease. So when you are accounting this in the books of Lessor, first we need to see must be classified at the inception whether it comes under the operating lease or finance lease. Now, generally the difference in case of finance lease, where the risk and reward will be transferred. So it means the risk and reward will be transferred to the lessee. And we can assume it as an operating lease, which is not a finance. So the definition, it simply says that if the risk and reward is not transferred to the lessee, then we can assume it as an operating lease. And if the risk and reward is transferred to the lessee, then we can assume it as a finance lease. Now, as per IFRS 16, the following indications that the risk and reward of ownership have been transferred. So there are certain important elements which are to be considered regarding the risk and reward. So the first one is ownership is transferred at the end of the lease. So if the lease, as per the lease agreement, if the ownership is transferred to the lessee, then that can be assumed as the transfer of risk and reward. The first point. And the second one, the lessee has the option to purchase the asset at the end of the lease term for less than the fair value. In simple terms, if the lessee has the option to acquire the asset at a nominal value. First one is ownership is transferred at the end of the lease. I don't think it requires much clarification. And the second point, if the lessee has the option to purchase the asset at the end of the lease term for less than fair value, it clearly specifies that for less than fair value. So fair value means there will be a specified agreed price for the lessee. If he would have been not a lessee, let us assume that I am a lessee for a specific asset. Normally, if I want to purchase the asset after the lease term, let us assume that as per the market value, I need to pay 1 lakh. But because I am a lessee, I can acquire that particular asset for only 40,000, which is nothing but less than the fair value. In that case also, you can assume that the risk and reward is transferred. I believe the statement 2 is clear, participants. Is that clear? Then the lessee can continue. Yeah, the lessee can continue to lease the asset at the end of the lease term for less than market rents. Now try to understand the difference between statement 2 and statement 3. In case of statement 3, the lessee can continue to lease the asset at the end of the lease term for less than the market rent because he already took the asset for lease basis. He can renew the lease at a price which is less than the market rent. Suppose at the first instance, I paid a rent of 50,000 for 5 years. And after 5 years, if I want to renew it, if I want to again take that the same asset on rent, lease, then as per the market rent, I should pay 30,000. But because already I am a lessee to the lessor, now I can take it only for 5,000 or 10,000. So if the lessee has a specific right to continue the lease agreement at a price which is less than the market rent, in that case also we can assume that the risk and reward is transferred to the lessee. And the next statement says that the lease term is for the major part of the asset's life. Now, generally, major part is nothing but if the lease term is around 70 or more than 70%, we can assume that it is major part of the asset's life. If the useful life of the asset is 10 years, and if you took the lease for 7 years or 8 years, and in that case also, we can assume that the risk and reward is transferred to the lessee. So generally 70% is considered as the major part. And the next one is the present value of the minimum lease payments are substantially all of the fair value of the leased asset. Present value of the minimum lease payments are substantially all of the fair value of the leased asset. Suppose if my present value of the lease payment is 1 lakh, and if the face value, if the total fair value of that leased asset is around, let us assume that 1,05,000. It means if the lease payments is 90 or more than 90% of your fair value, we can assume that substantially all of the fair value. Your present value of the lease payment is 90 and its fair value is around 95 or 1 lakh or 90,000. In that case also, just try to understand the logic behind it. See, if the fair value, suppose example, if the life of the asset is 10 years and its fair value is 1 lakh, and if I am getting, if my total, if the total present value of the lease payment is 95,000, now what does it mean? That the asset is given to the lessee for its full usage. So in that case also we can assume that the risk and reward is transferred. So just try to understand the statement 3, statement 4 and statement 5 before I go to the next elements. Let me know if you have any query on that. Yeah. Now these are the elements which we can consider for assuming that the risk and reward is transferred from the lessor to the lessee. Then lessor accounting treatment. Now under a finance lease, now how we need to account under the finance? If it is a finance lease, the lessor must de-recognize the leased asset, because anyway if the risk and reward is transferred, definitely you need to de-recognize the asset. So I hope the first one is clear. Second one, we need to recognize a lease receivable. Lessor need to recognize a lease receivable at the present value of the minimum lease payments plus the estimated unguaranteed residual value of the asset. Now we'll have a discussion on this. Recognize a lease receivable at the present value of the minimum lease payments plus the estimated unguaranteed residual value of that particular asset. Now, estimated unguaranteed residual value in the sense of what you understood with the statement. Estimated unguaranteed residual value of the asset. So whatever residual value which you are expecting on that particular asset, that will be added to this present value of the minimum lease payments. Suppose if you are receiving every year 50,000 and the lease term is for 5 years, then the total value plus the estimated unguaranteed residual value of the asset. So this is nothing but we need to recognize it as a lease receivable. Then we need to recognize the income on the lease receivable using our implicit rate of the lease. Nothing but income. How we will be recognizing this income? In the second step, we computed this lease receivable, right? Nothing but the present value of the minimum lease payments. Recognize the income on the lease receivable using the rate implicit in the lease. So whatever the implicit rate of interest is there, implicit rate is there on that particular basis, we'll be recognizing the income. It is just like the finance cost. In the books of lessee, you charge the finance cost on the present value of the lease liability into implicit rate of interest. In the books of lessor, we'll be recognizing this income by considering the present value of the minimum lease payments into implicit rate of interest. Right? This is for finance lease, and if it is an operating lease, you continue to recognize and depreciate the leased asset and recognize the lease rental income in profit or loss on straight line basis. So whatever lease income you receive, that can be accounted in the statement. This is very simple. If it is an operating lease, means if you are receiving if you are receiving 1 lakh per annum, that can be recognized as an income in the statement of profit or loss. But the main computation is for accounting treatment in the books of lessor if it is an operating, if it is a finance lease. First step, you should de-recognize the asset, then recognize a lease receivable at the present value, Then the third step, you need to recognize the income on that particular present value by suppose this is very, very important. Recognize the lease receivable at the present value of the minimum lease payments plus the estimated unguaranteed residual value. Recognize income on the lease receivable using the rate implicit in the interest. What income apart from the lease payments means? Generally, the other incomes will be if the lessee agrees to pay any specific amount. Suppose example, after because we are assuming it as a finance lease, at the time of when the ownership is transferred to the lessee after completing the lease term, if he is paying any amount, that amount can also be included. Suppose Mr. X took an asset on lease basis from Mr. Y for a period of 7 years, and every year X is paying around 70,000. Now, in the books of lessor, the present value of those 70,000 for the 7 years plus if X pays any amount at the time of transferring the ownership of that asset to X, that will also be included. Now, again, you should not convert that value into the present value because the residual value is nothing but the amount which we expect in present monetary terms, because most of the students are generally confused. Do we need to convert the residual value into the present value? No, you cannot, because residual value itself says that the expected value in present monetary terms. Suppose if you are expecting that you can recover around 50,000 as the residual value after 5 years, that 50,000 is in present terms only. No need to convert again it into the present value. Third point, you mean this one? Recognize the income on the lease receivable using the rate implicit in the lease. It means suppose here you will be getting a value, right? The lease receivable. If your lease receivable value is 1 lakh and if the implicit rate of interest is 9%, 1 lakh into 9%, that is 9,000, you will show it as an income. You will recognize it as an income. Now this lease receivable, just try to understand this. This lease receivable, you are showing it as an asset. And on this amount, by multiplying with the lease rent, nothing but implicit rent, you will be showing it as a income. Now let me put it in Excel sheet so that you will be getting. Suppose the present value lease receivable. You got it as 1 lakh. Then if your implicit rate of interest, now effective rate of interest of the lessor, don't confuse it. The effective rate of interest or the implicit rate of interest is 8%. So in the books of lessor, in our statement, in their statement of profit or loss account, they will show income that is 1 lakh into 8%. That is 8,000. I hope it is clear.
Sir, that 1 lakh is the total number, total lease payments over the lease period, or is it 1 year's
Yes.
payment?
If the lease term is for 5 years, it is the total present value of the lease payments, 1 lakh. That you can't show it as an income in the statement of profit and loss account. You will be recognizing it as an asset. Only income will be that 1 lakh into 8%.
So only the interest payments are the income. The rest is just asset. Okay.
Exactly. Correct. Any question on this? Yeah. We'll discuss a case study on this Lessor books also, but we'll discuss it in next session because already you might have exhausted on this. So we'll be discussing the case study in the next session. So the major tested points in the lessee, especially the main questions in the SBR also from lessee perspective only, and we covered all the main exhibits relating to the lessee perspective. So I hope the cons, because the main tested areas will be the controlling right, how the controlling right can be considered, how the non-controlling liability and the controlling liability should be considered, and how to recognize right to use of asset in case of sale and leaseback, how to recognize the profit on disposals. So these are the major elements, and how to deal with the improvements. This is a major points which will be tested in our strategic business reporting on lease. Any query? Others, Kyati and others, Gautam, Pavan. Okay. Yeah. So whatever sessions which we had till now, tomorrow by around 9 p.m. You can expect all the recording links. So I will be sending all the recording links to you. So here, should I send the recording links for each session, or you want me to drop all the recordings in one drive, or should I share that particular drive link? So which is more comfortable for you? Shall I drop all the recordings in one drive? Okay then. So I will share that direct drive link to you. I will upload all these links in your drive. I will upload it. Okay then. That's it for today. So we'll be continuing this. So tomorrow we'll first 30 minutes we'll discuss the keys on this lesser, and after that we'll be completing this taxation. So where we will be mainly focusing on deferred tax only, because current tax, I hope everyone knows this, will focus on deferred tax. Okay then, yeah, good night to all. So we'll discuss tomorrow.